Okay, so you know how some financial terms just kind of fly over your head? Like you hear senior bank loans and think, yeah, that sounds important, but you don't really get the nitty gritty? Yeah, happens all the time. They sound important, right? Exactly. Well, today we're tackling that one. You actually sent over a really good Investopedia piece on it, which was great because honestly, I was curious too. Good stuff. It's a fascinating area. So let's do this. Think of it as our mission. Dig into this article, pull out the key stuff, what they are, how they work, the rates, the risks, all that jazz. Sound good? Let's dive in. Where should we start? The name itself, senior bank loan? Perfect. Yeah. So the article starts by saying it's debt from a bank to a company, right? But then it gets repackaged. That's right. So a bank makes a loan, but then instead of just holding on to it, they often bundle it up with a bunch of other similar loans, bundle them up, like package them together. Exactly. They create this sort of collection of loans and then sell that package off to investors. It turns a simple loan into something you can invest in more broadly. Okay, that makes sense for investors. But that word senior, the article seemed to really emphasize that. What's the deal there? Yeah, senior is crucial. It's all about priority. It means this loan has the top legal claim on the company's assets compared to, well, pretty much all other types of debt. Top claim. So if things go bad for the company, like bankruptcy bad, precisely. If the company unfortunately goes bankrupt and has to sell off everything, buildings, machines, whatever it is, the money raised goes first to pay back the senior bank loan holders before anyone else. Before other lenders, people holding bonds that aren't senior, and definitely way before stockholders. They're at the absolute front of the line. Wow. Okay, so it's like having a guaranteed first spot if the worst happens. And the article also mentioned they're typically secured. What's that about? Is it like collateral? That's a great way to think about it. Yeah. Secured means the loan is backed by specific assets of the company. The bank gets what? It's called a lien on those assets. Yeah, it's a legal right. So if the company defaults, the lenders can actually take possession of those specific assets. Maybe it's inventory, equipment, even real estate, and sell them to get their money back. Got it. So it's not just a promise to pay. There are actual things backing it up. Double protection. Kind of. Yeah. The seniority puts you first in line, and the security gives you a claim on specific assets. Okay, clear. Now, why would a company choose to use this type of loan? What do they use the money for typically? Well, the article mentions it's often for everyday business stuff, funding operations, managing inventory, making payroll, general working capital, just keeping the lights on sometimes. Yeah, but also for bigger things like capital investments, buying new machinery, expanding a factory, maybe funding an acquisition, things they need significant cash for, right? And we said those loans get bundled and sold to investors. So what's in it for the investor? How do they make money? The return comes from the interest payments. The companies borrowing the money pay interest, and that flows through to the investors who bought the loan package. And the article highlighted something specific about those interest rates. They float. Yes, that's a really key feature. Unlike a lot of bonds that have a fixed interest rate for years, senior bank loans almost always have floating rates. Floating. Okay, how does that work? Does it just bounce around? Sort of. It's tied to a benchmark interest rate. The article mentioned LIBOR, which was common, though now things like SOFR are used more often. Okay, a benchmark, right? So the loan agreement might say the rate is like SOFR plus 4%. If SOFR is 1%, the loan pays 5%. If SOFR goes up to 2%, the loan then pays 6%. So the rate adjusts. How often? Usually it resets periodically, maybe every month or every 3 months. It tracks changes in those short-term benchmark rates. Interesting. So if interest rates in general are rising, then the interest payments on these loans would likely rise too. Exactly. It acts as a kind of natural hedge. If inflation pushes rates up, your income from these loans potentially goes up too, which helps protect your purchasing power. That's a big appeal for some investors. Okay, that makes a lot of sense. Now let's just quickly revisit that repayment structure. The article is pretty clear, but can you just walk through the order again? The hierarchy? Sure. Think of it like layers. At the very top, the safest layer, you have the senior bank loans, sometimes split into first lien and second lien, but still senior. Okay, top layer. Below that, you get unsecured debt. Think bonds that aren't backed by specific collateral, right? And then right at the bottom, the last to get anything, if at all, is equity, the shareholders. So senior loans, then unsecured debt, then shareholders. Got it. That really drives home the senior part. It does. And the article pointed out something interesting based on historical data. Oh yeah, what's that? That often, even when companies did go bankrupt, the holders of these senior loans actually got all or almost all of their money back. Really? A full recovery. That sounds pretty good. The track record is relatively strong because of that seniority and the collateral. And this is a big but, the article also stresses these aren't risk-free. How so? Well, the companies taking out these loans often aren't the big blue chip companies with amazing credit ratings. They're usually rated below investment grade. So they're considered riskier borrowers to begin with. Exactly. There's a higher inherent credit risk. They're statistically more likely to run into trouble than, say, a company with a AAA rating. Okay, so that's the trade-off. You're first in line if things go wrong, but you're lending to companies where things are maybe a bit more likely to go wrong. That's the dynamic. And the article also mentioned volatility, right? Thinking back to the 2008 financial crisis. Yeah, it said their values can fluctuate sometimes a lot, right? Because the market for these loans can seize up. In times of stress, people get nervous about the underlying companies. It becomes hard to sell the loans, and prices can drop sharply even if the loans themselves are still paying interest. So risk from the borrower and risk from the market itself. You've got it. So how do investors get compensated for taking on these risks? Higher returns. That's the idea. To attract investors to take on that credit risk and potential volatility, senior bank loans typically offer a higher yield, a higher interest return than safer investments like investment-grade corporate bonds. More yield for more risk. Yeah, makes sense. How do they compare to something like high-yield bonds, though? Junk bonds? Good question. They usually yield less than high-yield bonds. Less? Why is that? Because high-yield bonds are typically unsecured and lowered down in that repayment hierarchy we talked about. They don't have that same level of protection from seniority or collateral. Okay. So high-yield bonds have even more risk. So they have to offer an even higher potential yield to compensate. It's all a spectrum. Precisely. More risk generally means the potential for higher returns, but also higher potential losses. So if someone listening is thinking, okay, this floating rate thing sounds useful, maybe I'm okay with the risk, how do they actually invest? Can an average person buy these? Directly buying individual loans is tough for most people. The article points towards the more common routes, mutual funds or ETFs, exchange-traded funds that specialize in senior bank loans. Okay, funds and ETFs. Makes sense. Yeah, you buy shares in the fund and the fund manager buys and manages a whole portfolio of these loans. It gives you diversification instantly. And the article kind of circled back to the benefits there. Income potential, that floating rate advantage if rates are rising, right? For investors looking for income, especially in a rising rate environment, these funds can be attractive. It also mentioned something about attractive risk-adjusted returns over like 3 to 5 years. What does risk-adjusted really mean here? It basically means looking at the return you get compared to the amount of risk or volatility you experience to get it. The suggestion is that historically, over those medium terms, senior loans have offered a decent return for the level of bumpiness involved. Okay, and there was that interesting point about when funds underperform. Yeah, that it can actually be an opportunity. Yeah, that's a neat market dynamic. If market fears cause the price of the loans within a fund to drop, selling at a discount to their face value, then someone buying into the fund at that lower price effectively gets a higher yield going forward, assuming the loans keep paying out. So a dip could actually boost your potential future income. Potentially, yes, if the underlying loans remain sound. One last statistic the article threw out was the historical average default rate for these loan funds, around 3%. That sounds surprisingly low for non-investment grade stuff. It does seem low on the surface, doesn't it? But it likely comes back to that senior secured status. While defaults might happen more often with these borrowers, the amount the investor actually loses is often lower because they get first dibs on the assets. Exactly. The recovery rates tend to be higher than for unsecured debt or bonds further down the chain. So the net loss rate averages out lower. Well, this has definitely cleared things up. We went from just the name senior bank loan to understanding, the seniority, the security, the floating rates, how they fit in the repayment stack, the risks, the rewards, quite the journey through that Investopedia. Yeah, some key takeaways there. That senior status in bankruptcy is huge. Totally. That and the floating rate hedge against inflation were my big aha moments. It really shows how different debt instruments work for different needs and risk levels. Hopefully listeners feel like they've got a much better handle on this corner of the market now. Absolutely. It feels like a solid foundation for thinking about corporate debt more broadly. Okay, so here's a final thought to leave everyone with something to chew on. Given everything we've said about their place at the top of the capital structure, how might big economic shifts like a deep recession or maybe the opposite, a huge boom, how might that uniquely affect the risk and the return for both the companies borrowing this money and the investors holding the loans? Something to ponder. Ooh, that's a good one. Lots of interconnected factors there. Definitely food for thought. Well, thanks for digging into this with me today.